There's the expression sometimes in business that something's worth what someone's willing to pay for it. We like to take the approach that in God we trust. Everyone else has to show us how the numbers come together. So today we're quickly talking about how businesses are valued. There's lots of different lenses, different metrics, different approaches to it, but generally 4 lenses to look through, 4 approaches that we oftentimes like to focus on. So the first of these is yield. When you think of buying a business, you can think of the multiple being paid as some correlation to the yield that the company is going to generate. And so implicitly, if you paid 10 times for a business, the business will yield a 10% return every year if the business's performance stays the same. 5 times multiple would yield a 20% return. If you assume that a risk-free bond is trading at 5%, a multifamily apartment building is going to trade at 8%, then an asset-light operating company should trade at a multiple higher than that. Oftentimes the historical average has been around a 20% yield, implicitly a 5 to 6 times multiple. In more recent times, and as we're advocating for clients, we're able to push beyond that. But just to give you some metrics as to a framework of thinking of yield. And then this bakes into variable number 2, which is growth. And so if you think of when you buy a business, how are you going to make money? One is going to be the cash that's generated from the business every year. And the second is going to be any appreciation in the business when you ultimately exit it. And so when we're representing a company to sell them, we are backing into the analysis that an acquirer is going to make relative to both A, what are the cash flows generated on an annual basis, the yield, and then B, what is the appreciation of the business over the duration of ownership. And so similarly to if you bought an apartment building and you generated rent and profit for you every year, and then you sold the building for a profit down the road, the combination of that, spreading that out to the initial acquisition point, you can extract what they call an IRR, internal rate of return, or what is the compounding interest rate. But think of it generally from that framework. So A, you have yield, B, you have growth and how that plays into the ultimate exit value of a business. Now third, we start to get into the idea of comps or comparables. And this boiling back to other videos we've made relative to multiples of a business. And so while those multiples are based in yields and growth and exit values, oftentimes you can look at data sets of comps for similar companies. Now that's more relevant for larger businesses, and as you kind of get down to the sub $100 million transaction, they start to become a lot more all over the place. But it's that idea of what are people paying for similar businesses in similar situations of similar size and of similar complexity. Now, no two things are identical, and therefore there's a lot of negotiating and discussion around that, but comps are a good place to think about value as to, hey, these businesses tend to trade at 6 times or 7 times or 8 times, and therefore this particular situation should not deviate too much. And if it should, whether from an acquirer trying to say that this business should be worth less, or from our perspective saying this business should be worth more, there needs to be a good substantive backup for that point of view. And lastly, we like to think of multiples expansion as the last metric of value. And so when you think of buying a company at a multiple and what the comps are, the other thing to think about, as we've discussed in other videos, is what is that going to ultimately sell for as part of an aggregated consolidation. And so if a company goes out and says, I'm going to pay 6 times for $1 million companies and aggregate them, then by the time they've bought 10 of these $1 million EBITDA companies, they've bought $10 million worth of EBITDA for $60 million. Now, the notion is that once they have $10 million of EBITDA, the multiple expands, and now they can sell it for 10 times. So what they've bought for $60 million, they can sell for $100 million, and that's the notion of multiples expansion. So similarly, when we talk about yield, and we say you have to bake in growth, the exit value, we also say from a multiples perspective, what are the comps, what are things selling for, but also what is the multiple expansion thesis for the particular acquirer. And so from our view, when we're looking at how acquirers are looking at businesses, what offers we're receiving for a company, we want to reverse engineer these things. We want to know what is the yield they're assuming, what is the exit value they're assuming, what is the multiple they're looking at, what is the multiple expansion they're looking to grow into. And when you see all of these things, when you get your arms around all of these things, you're much better situated to negotiate for the optimal terms and structure. And so that's the thought for today. How's a company valued? 4 good places to look: yield, growth, comps, and multiples expansion. Hope the week's getting off to a good start for everyone. Keep pushing forward. God bless. See everyone next time.